Welcome back. U.S. oil prices are on track for another year of gains, small gains, and that's despite tight supplies caused by Russia's war with Ukraine and weakening demand from the world's top crude importer. That would be China due to lockdowns. Joining us now for more is Lipow Oil Associates founder and president Andrew Lipow. Andy, great to have you here as always. I'm looking at your price target and where you think WTI and Brent are going to go. You're saying WTI could go to $90. That's about $10 above the current price, and Brent also a similar amount to 95. Just wondering what factors into your analysis here.
Well, we have a lot of things that are happening in the oil market. First, if we were to look at the demand side of the equation, the two things that the oil market is wrestling with is, number one, is the reopening of the Chinese economy as the lockdowns are eased. But I don't think that we're going to see a real big impact of that reopening until the middle of next year. But it could be worth about 500 to 700,000 barrels a day of additional demand. But on the other side of that demand picture is the fears of a recession, especially in Europe, as they're coping with high energy prices from natural gas, as well as high oil prices as they seek oil products to replace that natural gas supply from Russia. Meanwhile, on the supply side in 2022, the world has really been making its way through with strategic petroleum reserve releases in the United States as well as elsewhere around the world. And if we look across the year, that has really added about 750,000 barrels a day of supply. As we go forward, these lower oil prices that we've seen recently are going to impact the supply growth we're expecting in the United States, with the Energy Information Administration has been continually revising downward their growth forecast of increased supplies here in the U.S. now to about 500,000 barrels a day, whereas one time several months ago was high as 900,000 barrels a day increase.
Andy, when you take a look at where prices are today, we have WTI crude just around $80 a barrel. We certainly have seen this movement to the upside over the last several days. The winter storm over the holiday, I guess, how big of a factor has that been for supply?
Well, this has been a pretty big impact, especially on refined products. At its peak, nearly 2 million barrels a day of Texas Gulf Coast refining capacity was offline. That's about 35% of the Texas refining capacity. So, of course, if the refineries aren't running, they're not making gasoline and diesel. When we think about on the production of oil, the blizzards in North Dakota took off about 300,000 barrels a day of production, which will slowly recover. But more seriously, on the natural gas side, we lost about 10 to 15% of our natural gas production throughout the country as the cold weather impacted those fields in Texas and Oklahoma all the way up through Appalachia.
Andy, I want to ask you about those sanctions that we were talking about a little bit, just touched on them, against Russian oil. Those seem to be largely symbolic, and the net effect is that we do have oil, low-priced oil being piped into Europe from the Urals. But what do you see in the new year? If things escalate with respect to Russia, Ukraine again, could we get another situation where we see crude, at least momentarily, spike up well above your price targets for the end of the year?
Well, it certainly could happen because in 2022, we saw oil prices for WTI get to $130 a barrel. So there can be a significant amount of volatility in the oil market. We had the European Union impose their sanctions on Russian crude oil purchases starting December 5th. Now what I'm looking ahead to is February 5th, when the sanctions begin on Russian refined products, and more specifically on diesel supply, where Europe has been buying about 700,000 barrels a day of diesel from Russia. So there is going to be a scramble for new supplies to backfill those lost supplies that have been available out of Russia. And we're going to be looking towards new refining expansions and capacity coming online in the Middle East as well as China in order to make up the difference.
Andy, when you look over at what's happening in China, of course, we've had the surge in cases, lots of questions about how extensively, or I guess how much that could really hold back the reopening there. When it comes to the impact that you see that having on crude, could we potentially maybe not hit your target and actually end up below 90 bucks a barrel at the end of 2023?
We certainly could, especially if the return of Chinese demand becomes a disappointment and the economic factors around the rest of the world cause a deeper recession than people are calling for. And you could actually see oil prices plummet. And we saw that happen in 2008 and 2009, as well as in 2014 and 2015, where we saw oil prices back in the $30 a barrel range and $45 a barrel range, respectively.
All right, Andy, always great to have you. Andy Lipow, Lipow Oil Associates founder and president.